presentation contains current opinions of Moez Ansari, Chief Investment Officer of Compact Asset Management, a registered investment advisor, and are subject to change. Nothing in this presentation should be considered investment advice. We make no assurance that Mo's opinions or illustrations will accurately predict future prices or financial markets. In no event is past performance a guarantee of future performance. A detailed disclosure can be found at the end of the presentation. And now here's Mo.
Hello everyone, and welcome to the Compact Market Wrap YouTube update for October the 13th, 2025. First of all, I want to remind all of you to click on the subscribe button so whenever I post an update, you'll be notified and you can watch it at your convenience. If you need help with your portfolio, just send me an email at invest@compact.com or give me a call. Friday was a scary day where the market was down quite a bit. For the week, the S&P was down 2.41%, Dow was down 2.7%, Russell down 3.28%. We saw also the NASDAQ down 2.53. The good one was emerging markets only down 0.58%. Why did the market go down? The president, China put restrictions on the materials, these are materials, these are metals that are used in everything, making chips, and they're used throughout the defense industry, and China put on these minerals that they put restrictions on. The president in response said that we'll put 100% tariff, but none of these go into effect until next month. But the scare was that the tariff war is back. So that scared everybody on Friday. The market is all looking for good news, slight bad news, and it was down big on Friday. Today we're back up, but the bond market is closed, so we'll really see the effects and see if we get some follow through tomorrow after today's bounce. We did manage to close above the 20-day moving average. I'll show you the charts a little bit later on. Utilities were up last week as they continue to move higher. A lot of this is the AI trade where they have to provide energy to all these huge data centers. The worst was energy down 0.40, consumer discretionary down, real estate down last week big. Oil was continuing to sort of bounce around the $60 mark today. It's up a little bit today, but last week closed at $61.50. But interest rates were down big. They're down pushing that 4% area again from 4.13. We closed at 4.05. Today there's no trade in the bond market for the Columbus Day holiday, and so we saw the market. We'll find out tomorrow how the bond market will react to the pullback on Friday. One thing that we've seen is tremendous amount of buybacks. That's where the U.S. companies are buying their own stock. When less of it is available, the prices go down. You can see that we're buying a tremendous amount of stock over the last 5, 6 years. But you can say this year, it is way down the number of stocks, the buybacks that we're seeing. We're seeing a tremendous amount of increase in Korea. Japan is still buying quite a bit, not as much as it did last year, the Japanese companies, but we are seeing. What happens is when these companies make a lot of money, they have this excess money sitting around. Usually in the old days, they used to give a dividend to the shareholders. But once you give a dividend, you can't take it back. You have to sort of continue that dividend for a long period of time or forever. So what companies are doing, instead of giving dividends, they're buying their own stock. When they buy their stock, the price of their stock goes up because there's less stock floating around. The float goes down, as it's called, and the demand for that stock is going up. So that has been helpful for the stock market, but this year we haven't seen as many buybacks. Consumer sentiment fell last week to 55 in October, but we don't have a lot of data. We're supposed to get the CPI on Wednesday and the inflation number. We do not have the unemployment number because the government is closed. Right now, there's not a lot of talk about the government today. There's always talk about, there's obviously the focus on the peace plan in the Middle East, which is a tremendous change that the president has brought about in the Middle East. They've been fighting for 75 years. So if he can get some kind of peace and resolution there, that would be, I think, a tremendous boost, not just for Israel and Gaza, but also for the rest of the Middle East, which is trying to become more economically, more tourist-friendly, more develop their economies much more, instead of just having an oil economy. But they have to have peace to do that. So I think there's a great chance here that we could get a broader peace. We have the first blocks in place, but now we have to build on those blocks. So we'll have to wait and see if that does come about, and if it does, that would be great news overall for the world. Looking at we're looking at manufacturing coming out, Philly Fed, not a lot expected there. Technically, we sliced right through. This is the 20-day moving average right here, the red line. We sliced right through it, came close to the 50-day moving average, which we have not seen since about here, since we broke above it in May. This was the April drop right here, and since May we've gone straight up. So now we're testing the 50-day, which is 65.38. We were 65.50 this morning. we were at 65.20, 66.20 this morning. 66.52 is the close. So we popped back up right close to the 20-day moving average. We just are right there, this red line. You can see this green right here is pushing this red line. So we'll see if it gets some follow through and come back and go right through this on the upside and continue to move higher. One day does not make a pullback, does not make a correction. Usually if this second wave, this is wave 1, wave 2, wave 3, as I've mentioned, sure, 4 should be down and then 5 back up. But if wave 2 is simple, which this is just a straight down, straight up, but wave 4 is usually goes back and forth for a period of time. So if wave 4 have started, it's going to be back and forth for a period of time. That's what I expect to see instead of a snap back up and straight up again. But we have to hold this 50-day moving average, which is 65.38. Technically, weeklies are higher. 63.82 is the 20-week, and then the 50-week is right at the 200-day moving average, obviously. So looking at the daily NASDAQ, again, we came right down below the 20-day. Today, popped right back above it. So we'll see if we can continue this. This was just a one-day blip in the market, or we have more chop in the market. I expect to see more choppiness in the market from here. Looking at the 10-year note, we're just going back and forth right here. We've tightened the range a lot, but as long as 4 is okay, if we get much below 3.8, which was this low, 3.9 right here, I would get a little bit concerned. And I'm watching the high yield market. It is starting to deteriorate, which is the canary in the coal mine, as I call it. And you look at that, gold continues to move higher as people are looking to move out of the dollar and into gold. And you look at the bond index, you can see that the bonds, high yield bonds, this is the ETF for high yield bonds, and it sliced through everything. It was not only on Friday, but all through. It has bounced up today, but it's still below the blue line, which is the 50-day. It's still below the red line, which is the 20-day moving average, and that's right around 80.74. As long as you stay above the 200-day, if you get below the 200-day on the high yield bonds, that'll tell me there's something going on that people are worried about. This week we get earnings, which is really going to show. We start with the financial companies this week, and then we move into the rest of the companies. So the next couple of weeks are going to be critical for the high yield bond market and for the stock market and earnings, which have to be perfect. We'll have to wait and see how those come out. Looking at this, again, those are my thoughts. Looking at the market, more chop expected over the next couple of weeks in this market, back and forth, as long as we stay above the 50-day. If we get below the 50-day, then I would get a little bit concerned, which is 65.38. Again, if you need help with your portfolio, go to invest@compact.com. You can go ahead and send us an email or just call us at 800-388-9700. Don't forget to subscribe to this channel. Click on this button right here, and you will get this update whenever I post one. Looking at if you want the historical insights, you can go to compact.com, click on Insights, and you'll get the podcast, which is a much longer version of this, but without the charts. It's Javed and I talking about the markets in a lot more detail, but this gives you a quick idea of where we are and what I'm thinking. Those are my thoughts. Those are my observations for this week. We will be back with you next week. Until then, good trading.
This presentation contains the current views and opinions of Moise Ansari, Chief Investment Officer of Compac Asset Management, a registered investment advisor. The views expressed are current only as of the date of this presentation and are subject to change. Nothing in this presentation should be considered investment advice, and nothing is personalized to any investor's individual circumstances. Compac Asset Management offers investment advice only after entering into an investment advisory agreement and gathering client-specific information about goals, objectives, financial status, and risk tolerance. This presentation uses terminology associated with technical analysis and provides charts to illustrate some of the concepts discussed. Technical analysis is a security analysis method with the goal of forecasting the direction of prices of securities or market indices through the study of past market data, primarily price and volume. We make no assurance that past performance or the use of technical analysis will accurately predict future prices. Further, a risk of technical analysis is that overfocus on historical patterns could lead to ignoring or downplaying security-specific concerns, overall market or sector concerns, or other factors because we assume inaccurately that historical patterns will repeat themselves. In no event is past performance a guarantee of future performance.